Yesterday, we launched the trial of our CBDC project. It was indeed a landmark moment in the history of money, in the history of currency in our country. Going forward, it will be a landmark moment. It will be a landmark achievement so far as the functioning of the entire economy is concerned. So in that sense also, it's going to be a major transformation of the way business is done, the way transactions are conducted. And the Reserve Bank is among the very few central banks in the world which have taken this initiative. Last month, we launched also a pilot project on end-to-end digitized KCC loans, Kisan Credit Card-based loans. The pilot projects are now in operation in the states of Madhya Pradesh and Tamil Nadu, based on its end-to-end digitization. So whereby the customer, the KCC, that is the farmer, he applies through his mobile, then the system handles it straight away. The bank processes it. The data from the credit rating agencies, that data flows in. The satellite data is used through artificial intelligence to analyze the state of his land at that moment and what was cultivated in that land in the previous years. So it's an end-to-end digitized, process, a complete digitized process to grant the loans. The farmers don't have to visit the bank branch once or twice or thrice. Process of documentation is simple, and our effort, our endeavor, in association with the participating banks and the state governments concerned in this case, to ensure that the farmers get the loan at absolutely minimum amount of time. Depending on the learnings that we have from the CBDC pilot project and the learnings from this end-to-end digitized KCC loan, our endeavor is following. Number one, to try and launch the CBDC in a full-fledged manner in the near future. In fact, incidentally, the retail part of the CBDC trial will be launched later during this month. We will announce the date separately. But I don't want to give a target date by which time the CBDCs will be launched in a full-scale manner, because this is something where we have to proceed very carefully. This is the first time the world is doing it. We don't want to be in a great hurry. We want to learn from the experiences of the way the projects, the pilots are running. There will be some technological challenges. There will be some process challenges. We want to iron out all those aspects and introduce it in a manner that the whole process, the whole introduction and thereafter is non-disruptive. Similarly, second point I want to mention is that based on the learnings and experience of this end-to-end digitized KCC loans, our endeavor would be to launch it in a full-scale manner, everything going all right, not only for the farmers' loans, but also for the small and also for the SME loans. And if everything goes all right, we hope to do that, launch it on a nationwide basis sometime during the year 2023. I'm not referring to financial year, I'm referring to the calendar year of 2023. Of course, we are working closely with our banking partners. In fact, it will be extended in due course to all the banks. Currently, it is being done by 2 banks. 2 more banks are about to be onboarded very shortly. The banks will have to upgrade their technology simultaneously. And what is more critical is that the state governments also need to completely digitize their land records and the process of verification of the title, so that the title verification process also is simplified. Good morning, everyone. Shri Sanjeev Mehta, President FICCI, Shri A.K. Goel, Chairman IBA, Shri Sunil Mehta, Chief Executive of the IBA, other dignitaries on the dais, members of FICCI and IBA, friends from the media, ladies and gentlemen. What I mentioned earlier was by way of a starter. Now I will get into the main course. I'm happy to be here, and I'm also extremely happy to have been invited to this annual FIBAC 2022 conference. I distinctly remember that I was here in this hall participating in the FIBAC 2019. That was 3 years ago. So therefore, I am doubly happy to be back after a period of 3 years. Now, this is an important forum for the banking industry as well as for business. We have the presence here of thought leaders, banking practitioners, stalwarts from the industry, and several technology players, some of whom have put up their stalls just outside this hall. So I'm extremely happy and delighted to be in a gathering like this. Now, this conference is being held at a time when the global economy is going through a process of churning. Triple shocks of COVID-19, the war in Ukraine, and the current financial market turmoil have created a toxic mix of factors and circumstances which every country has to grapple with. The International Monetary Fund, in its recent annual meeting, has presented a rather somber outlook for the world economy and the world trade. And it has also gone on to make downward revisions in its growth projections for the current year as well as for next year, and also downward revisions in the volume of global trade. The existing international order is undergoing fundamental shifts in terms of geopolitics and economic relationships. Now, the confluence of these factors and circumstances is reverberating speedily across jurisdictions through various modes and spillovers. With monetary policy actions and stances undergoing a regime shift in the advanced economies, financial conditions have tightened sharply across markets and have accentuated financial stability and have accentuated what I call, financial stability risks. Emerging market and developing economies, that is EMDs in particular, remain highly vulnerable to these global spillovers. Capital outflows have led to reserve losses, sharp currency depreciations, and spiraling imported inflation pressures. And this has happened across EMDs. Several countries face acute debt distress, while many others are confronted with elevated food and energy prices. Conventional and technocratic policy making is increasingly getting challenged by unconventional and out-of-the-box approaches. In this unsettling global environment, the Indian economy has been growing steadily, drawing strength from its macroeconomic fundamentals and buffers. According to the IMF, India is slated to be one of the fastest growing major economies of the world in the current year as well as in the next year. Our recovery and growth have been more broad-based. Our policies, fiscal, monetary, and regulatory, were prudent, targeted, and time-bound. We were careful to ensure that demand remained in balance while supply conditions improved. As per the high-frequency indicators for the recent months, and in Reserve Bank, we monitor nearly 70 high-frequency indicators on a real-time basis. Now, as per these high-frequency indicators, especially for the recent months and the weeks, we find that private consumption, especially urban demand, has remained quite healthy. The contact-intensive services have continued to make smart rebound, and aided by unfettered resumption of activities and full-fledged celebration of festivals after 2.5 years. So you see huge amount of participation we all saw during the Ganapati festival in Maharashtra and other places, and also during the Diwali festival. And as the data is trickling in and flowing in, we find that the sales of various, the overall retail sales of various goods, the white goods and other fast-moving consumer goods have also improved considerably. Now, amidst all this, external demand, however, remains a weak spot in the face of accentuating global economic slowdown. Domestic inflation remains elevated, We are closely monitoring the inflation trends as well as the effect of our past actions. In our view, that is in Reserve Bank's view and in my view, price stability, sustained growth, and financial stability need not be mutually exclusive. In the Mahabharata, during the famous Swayamvara, when the great warrior Arjuna was aiming at the eye of the revolving fish. There was a fish and the fish was revolving during the Swayamvara. I'm quite certain, and he was looking at it through a pool of water which was underneath. I'm quite certain that he would have certainly assessed the speed at which the fish was revolving, the wind conditions prevailing, the intensity of the ripples in the pool of water below, the noise levels in the king's court, and similar other factors. No one can match the prowess of Arjuna, but our constant endeavor is to keep an Arjuna's eye on inflation, which is our primary target. At the same time, we keep assessing other related factors like the evolving inflation growth dynamics, soft indicators like our surveys and of consumers and surveys on consumers and businesses, global macroeconomic, financial and commodity market developments, and aspects of financial stability. In other words, our policy measures are based on an assessment of the overall situation. We will continue to steer our policies accordingly. In this direction, our continued effort is to put in place strong institutional frameworks to ensure a sturdy and resilient financial system that would be ready for the challenges in the future. Let me highlight what I have done is actually I have highlighted about five specific areas, but I will not read out that part of the speech. I would rather speak in a more informal and in a more conversational manner. And the five areas are, the first area is basically, I've talked about the monetary policy framework and flexibility. As I have said earlier on several occasions, and as our various publications from the Reserve Bank have explained from time to time, during the pandemic, we utilized the flexibility embedded in our monetary policy framework to tolerate a slightly higher inflation, but within the range of 2 to 6%, to ensure that the economy, overall the economy remained resilient and financial stability was maintained, with a clear objective that when situation normalizes, we will bring down the inflation to 4%. Now, in the process, today, we are in a situation where, the inflation has remained above 6% for 3 consecutive quarters, and under the accountability norms which are provided in the Reserve Bank of India Act, we are expected to send a report to the government explaining explaining as to why it happened, what measures we propose to take, and by which time we expect inflation to come within the target range of 2 to 6% and closer to 4%. This is what has been provided in the law. We are having a monetary policy meeting tomorrow. There's a lot of media reports and a lot of speculation about the whole process, because this is the first time India is experiencing something like that. The Bank of England writes this letter almost every month for the last 1 year or so. There are other central banks which also write similar letters. For them, it's not the first time. But in our country, the inflation framework itself is pretty recent. It was instituted in 2016. So the MPC will meet tomorrow and we will prepare a report and we will send it to the government. There is also some amount of speculation about what the Reserve Bank will write, and some people have gone on to conclude, based on what I replied in a post-monetary policy press conference. They asked whether the RBI will release it. I said, no, the RBI will not release it. It's for the addressee, the government, to decide and do the needful in this regard. Now, questions have been raised about transparency of monetary policy, transparency of what we are doing. This is such a sensitive bit of information. How can RBI keep it under the wraps? The entire monetary policy framework, which was instituted in 2016, is based on very strong principles of transparency. The minutes of the meeting are released as soon as the meeting is over. The minutes of the meeting, the resolution of the MPC, it gives out what are the decisions and why those decisions have been taken. After 2 weeks, the minutes of the individual members are also released, so that everyone knows who said what and how it facilitated a decision making. So the expectation is that since we release the monetary policy resolution on the day of the MPC, why don't we release the letter itself also on the day of the MPC? You see, I just want to place before you for consideration, and I would like you and the others who may be, listening to this interaction, this speech through the RBI YouTube channel. And let me say that the RBI YouTube channel and other social media platforms are also, live streaming this for the wider audience, especially from the financial sector. You see, the MPC resolution is meant for the entire economy. Immediately, the market should know what is the RBI's decision. Citizens of the country should know what is the RBI's decision. Unlike that, the letter in the case of a letter which which the Reserve Bank writes to the government, it's a report sent under a law. I don't have the privilege, the authority, or the luxury to release a letter like this, which is written under the law as per the legal requirement. I don't have the privilege, authority, or the luxury to release it to the media before even the addressee gets it. There's so much of communication which goes on between the Reserve Bank and the government, both ways. We don't share each and every letter. But that is not to assume that the contents of this letter and the report are going to be perennially, under wraps. They will be available in the public domain at some point. So the limited point that I was making, and I don't want to be defensive about it because that is the legal position. I have no authority to just write a letter to government and then release it to the media. It's not like, in the political space, for example, there are leaders who write a letter to the government and immediately release it to the media. That is for a different purpose. Here, the first right of receiving the letter lies with the government. The addressee should get it first. In due course, sooner than later, it will be out. The parliament will know about it. The standing committee of parliament will know about it. It will be really, the contents will be known. So it is not as if there is transparency being compromised in any manner. And I want to say it very emphatically that the monetary policy framework instituted in 2016 is a very transparent framework. And the writing of the letter is also very much an essential and fundamental element of that transparency. Nobody is hiding anything from the public, but it's a question of time. And I think it should be seen in that context. In fact, I can say that the framework itself, we give it a lot of importance. When the framework had to be re-notified in 2021 March, in 2021 March, for the next starting 1st April 2021. There was speculation, and in fact, there was some argument in certain sections that the target itself should be, increased. The median point instead of 4% should be 5%. In fact, people have also questioned the necessity of a framework for a country like India. But we stuck to the framework which was instituted in 2016 because it was instituted after a lot of consideration and a lot of research within the RBI. And the RBI research showed that the mean point of 4% has its relevance for maintaining overall macroeconomic stability and for supporting growth. And any inflation above 6% can be detrimental to growth. So the whole purpose of having an inflation framework for the convenience of the people, for keeping prices low for the people, or for ensuring financial stability and economic growth, the purpose would be lost. So therefore, we reiterated the importance of continuing with the target, and we were very happy, and that that the government also appreciated our point of view. The government agreed with our point of view, and they have re-notified it. So on the first aspect I have highlighted here is with regard to, I've said few other things about our forecasting methods, about digital rupee, etc. I'm not going into the detail of it. The second aspect which I have highlighted is that the second component of our effort to ensure financial stability is to bring about systemic changes, to bring about reforms in various key segments of the financial sector. During the pandemic and during this entire crisis period, the Reserve Bank continued to work as it, as if it was normal time. It was, in fact, for Reserve Bank, our working hours, at least for the top management for the first year, and thereafter for almost for everyone, it was business as usual. And I would like to place before you, I have listed out the kind of reforms which we have carried out in the financial sector. And we have instituted new frameworks, new regulatory guidelines in several areas. And these include, one, the guidelines on governance in commercial banks. We issued it in April 2021. Number two, a steady state prudential framework for resolution of stressed assets in June 2019. This was after the Supreme Court struck down the earlier circular on resolution of stressed assets, whereby one-day default led to a default and process of resolution had to be initiated. After the Supreme Court struck it down in 2019 June, we have instituted a new framework. That was the second major step with regard to, sort of streamlining and reforming our regulatory framework for the financial sector. Three, securitization of standard assets, and this was done in July 2021. Four, very important, scale-based regulatory framework for NBFCs in October 2021. Five, revised regulatory framework for urban cooperative banks in July this year. Six, guidelines on digital lending, which were issued in September this year. Seven, revised guidelines for asset reconstruction companies in October this year. And number eight, issuance of a discussion paper on climate risk and sustainable finance in July this year. So as you can see, continuously we are focused on bringing about regulatory changes in which will affect the financial sector and which keeps the financial sector resilient and ready for the requirement of the future. We are talking of India at 100. We are talking of India at 2047. We are aspiring to become a 5 trillion economy and then go on to become the fourth or the third largest economy after some time. Now, we want to prepare our financial system for that kind of challenge and to sort of be in sync with the requirements of the time. The third area where we have again focused a lot is with regard to the supervision in the financial sector. I'm not going into it in detail. I have talked about it in at great length in many fora earlier and separately. But the thrust is now more on identification of the root causes of vulnerabilities in individual entities as well as in the financial sector as a whole, and to ensure that suitable measures are taken for mitigation on proactive basis. The fourth aspect which I have talked about, this speech will be, a copy of this address will be uploaded in the Reserve Bank website as soon as my speech is over. So those of you who are interested can have a look at it, and especially from my, for my friends from the media, many of whom are present here, you may have a look at it as you have done earlier. Now, the fourth aspect where we are focused is on developing financial markets. The development of financial markets has been a key priority for the Reserve Bank. We have been undertaking calibrated reforms to develop vibrant and resilient financial markets. These reforms, that is the reforms which we have undertaken, among other things, they seek to remove market segmentation, facilitate access, including access for non-residents, widen the participation base, promote innovation, and ensure customer protection. The other details are given here. I am not going into it. The fifth aspect which I have highlighted relates to the payment systems in India with focus on interoperability, cross-border linkages and innovation. This has been talked about quite a lot. And let me also mention here, it was during the COVID-19 pandemic that we introduced 24/7 NEFT in January, I think in January 20, in December 2019, if I remember correctly, and 24/7 into 365 RTGS. And that was, we are one among the few countries in the world to have 24/7 into 365 RTGS operations. We introduced in, if I remember correctly, I think that was done in December 2020. And there are very few countries which have done. The UPI has, as all of you know, has emerged as a major innovation, has emerged as a real, I think it's being talked about all over the world. We have brought about, we have also brought about, we have set up this innovation hub. We have introduced a regulatory sandbox. We have also recently announced a sandbox for, hybrid products and products which, involve several regulators. So all these things I have mentioned in my speech, and I'm not going into that. Now, I think I'm overshooting the time. So sorry about that. But I think, I'm speaking after a long time in the public fora. So, and there is a lot of interest, I'm sure. So I must utilize the opportunity, and I sort of request your patience. Now, I have talked about the triple shocks of COVID, the war, and now the financial market turmoil. I don't know what is in store for us next, but we have to be constantly prepared. As we stand here, or as you stand in your respective places, in your businesses or in your institutions or in organizations, if you look at how the Indian economy looks today, I think India today presents a picture of resilience and optimism. And this was the sentiment which has been expressed by many countries in our interaction with them last month when I participated in the IMF annual meetings, and not only in the IMF plenary, but also in our bilateral discussions with several other country, the central banks and finance ministries who were present there. Now, how this has been possible, I think that is something which needs to be kept in mind, and we should not forget. Much has been made about RBI, not being able to adhere to the inflation target. But I would request you to consider, just step back for a moment, pause for a moment, and think about if we had started the process of tightening earlier, what would have been the counterfactual scenario? What you prevent in the process doesn't get the kind of appreciation that it should get. We prevented a complete downward turn of our economy after recording negative growth in the year 2020-21. India's economy, bounced back in 21-22 and sustained in 22-23 and also next year. Now, how was it possible? If we had prematurely started tightening, I mean, there is a lot of public debate. I think history will judge. There will be several points of view expressed. But it is our sincere and firm belief, and especially in the early part of this calendar year, in January, February in particular, when we looked at the inflation trajectory, our assessment showed that the inflation during the year 22-23, that is the current financial year, the average inflation would be 4.5%, CPI headline inflation. We had done our scenario analysis. We had that time, nobody had thought that the oil prices, the crude prices will shoot up so much. We had done our internal analysis, assuming $100, and that time the oil, crude oil was about $82, $83. We had assumed $100. Which was, the kind of extremely high level, which, so we just did a scenario analysis, and even then we found that the inflation is going to be around 5%. So we didn't want to upset the process of recovery. We wanted the economy to safely land, in the turbulent waters through which the economy had been sailing through the period of COVID. We wanted the economy to safely land the shores, to reach the shores, and thereafter try and pull down inflation. But then on 24th February, you had the commencement of the war, and within matter of 3-4 days, the crude oil prices, the commodity prices, the food prices, large number of countries are importers of food from that part of the world. Wheat gets imported, edible oil gets imported. In India, we import a lot of sunflower oil from the Black Sea region. And when international prices of wheat went up, in India, despite India being a surplus, despite India being surplus in wheat, our domestic wheat prices also went up. And crude prices, it hit $130 per barrel, then it came down to about 120. And it stayed around 120, then it hovered between 110 and 120. So 24th February completely changed the entire picture. And it was not just our analysis of that during the current year, the inflation would be 4.5%. Even the professional forecasters had projected the inflation to be anything between 4.5% to about 5.1 or 5.2%. So that was the expectation. So therefore, the counterfactual also needs to be appreciated. In the process, yes, there has been a slippage in our inflation targeting, in our capacity, in our ability to maintain the inflation below 6%, but it would have been very costly for the economy. It would have been very costly for the citizens of this country. We would have paid a high cost. And I think that is something which needs to be appreciated. The timely actions, the Reserve Bank has been taking timely action. When the COVID hit us, the nationwide lockdown was announced with effect from 25th March 2020. 5 days before that, or 6 days before that, we had started our quarantine facility of all our market infrastructure. 200 service providers and RBI employees were put in quarantine, and that quarantine lasted for almost 2 years. 27th March 2020, we announced the first set of COVID relief, COVID support measures. And we, in quick succession, 27th March, April 17th, and on 22nd May of 2023, in 3 quick successions, we announced several measures. More than 100 measures were taken during the COVID. When Delta suddenly suddenly hit our our country in April and May of 2020, we came out with several measures, including provision of liquidity for contact-intensive services for the healthcare sector. We came out with a new resolution framework for the MSMEs because we wanted the MSME sector to be protected. Now, this year, when I have explained the background, when because of the COVID, because of the Ukraine war, when suddenly inflation spiked, and not just in India. I mean, you look at the inflation level in other countries, advanced countries, where the inflation, in fact, the terminology of low for long, they were maintaining 2% inflation, and they were consciously trying, the central bank was desperately, they were consciously trying to push up the inflation a little bit because it was being negative. The real rates were negative for far too long. They are today at 10% plus inflation, CPI retail inflation. Our last inflation print, as we had expected, it has come more than 7%. Going forward, we expect the inflation to moderate. We have given the trajectory for that, so I don't want to again load you with that. So when that happened, the war came without any, the war came as a surprise. The war came with any advance notice. So we had to hold an off-cycle policy meeting of the Monetary Policy Committee. That was also a surprise. So, I mean, it's not possible. The war comes as a surprise. The war came without any advance notice. So we had to act quickly. We could not have delayed our action, just to maintain because we had not said and market would be surprised. Sometimes negative surprises will be there, and one has to be prepared for it. If the war gives a negative surprise, if the COVID gave a negative surprise, COVID gave a huge negative surprise. But that time, we gave a lot of positive surprises because we could afford to do that. And because of inflation targeting framework, our average inflation till the COVID-19 hit our country or the world, our average CPI inflation was 3.9% from 2016 to February 2020. So we had the space to do that. Similarly, now, when the war started this year in February, in April, we announced in our monetary policy number of measures. I am not going into it in detail. We started giving priority to inflation. We introduced SDF. You know what is SDF? That is for liquidity absorption, and we increased the rates. Instead of reverse repo, we had the SDF at 40 basis points higher rate. So we had to act, but it was a negative surprise. But it was necessary and it was important to do it. And because we did that, today I can say with confidence that this whole debate about the Reserve Bank behind the curve, that debate has ended. It's no more there. Now, so therefore, I think this whole question I'm addressing about this inflation targeting and all that. Now, where do we stand today? The growth momentum has been sustained. Inflation is expected to moderate. The banking, the non-banking, that is the banks, the banking, the non-banking, and the entire financial sector is stable. It is resilient. It has withstood multiple shocks. In fact, the balance sheets of the banks are today looking very robust. I don't need to give the figures on GNPA, on the provision coverage ratio, or how well capitalized the banks are. The corporate sector balance sheets are also strong. And I'm happy to note that both banks and the corporate sectors, they mobilized a lot of capital, or they did a lot of deleveraging during the crisis period of 2020 and 2021. The MSME sector has also withstood the crisis. The credit offtake, the latest data which we have released, which you have released, I think the data pertains to as on 7th October, or it's there in the RBI website. You can just see that. The credit flow is the highest in the SME sector. It's in the region of about 27% or 36%. One of them is about 27%. The other one is about 36%. I think the small industries are getting credit. The growth is about 27%, and the micro is about 36% or something. It's there. I may be slightly wrong in remembering these figures. So where do we stand? As I mentioned, the momentum is sustained. Inflation is moderating. The financial sector is stable and resilient. MSME sector has withstood the crisis. The excess liquidity which we had injected during the COVID-19 pandemic has been substantially drained out. We were, of course, we were also helped by our forex, intervention in the forex market. Credit offtake, as I just mentioned, has picked up. The 24/7 RTGS is fully functional. UPI is recording new volumes of transactions. The CBDC has been launched, and several other measures that have been announced, about which I talked. Now, all this, did they happen just like that? I think it happened because the Reserve Bank, the government, the banks, and every stakeholder in our economy, including the private businesses, the MSMEs, everybody, I think we all work together as a country, and we have made it possible. And these are things, I think, which need to be appreciated. Now, I have taken again too long, but there are two aspects on which I'm sure there is a lot of interest, and I'm sure the participants would like to hear. One is on, the first one is on liquidity situation. The second one is on the exchange rate of the rupee. So it will be only fair that I address both these issues. Now, in the month of October, the interaction of global, first I will talk about the current liquidity situation, because there is a lot of talk about liquidity being tight. Now, in the month of October, the interaction of global and domestic developments has somewhat tightened the liquidity conditions. Average daily absorption under the liquidity adjustment facility, that is LAF, amounted to rupees 1.35 lakh crore during the month of October. That is the liquidity at the end of the day which Reserve Bank absorbs from the banks. Now, this is compared to rupees 2 lakh crore, which was prevalent in September. The tightening of liquidity in October is attributed to several factors. During the month, currency demand was high on account of the festival season. This constitutes a leakage of liquidity from the banking system. That is when the currency is in circulation goes up, the liquidity available with the banks that goes out to the hands of the people as currency notes as currency. The Reserve Bank's forex market operations, along with GST and other tax-related outflows, also drained out liquidity. Banks partially ameliorated the liquidity stress by drawing down their excess CRR balances and non-SLR investments. Certain banks also took recourse to MSF. Now, this episode of liquidity strain is likely to be transitory on account of several factors. First, the leakage due to currency demand will slow down once the festival season is over, and it is almost over. And as the currency returns to the banking system, the system liquidity will improve. Second, government expenditure is likely to pick up after the monsoon season. Usually in the monsoon season, usually in the second half of the financial year, the government expenditures tend to pick up and gather substantial momentum. Third, the pace of forex outflows has moderated, which augurs well for system liquidity going forward. Net FPI investments, which were robust in August but turned negative in September, have resumed in October. And October, there were, on a net basis, there were inflows. Fourth, deposit growth of banks have also picked up in recent fortnights, and especially in recent fortnights, and is working towards bridging the funding gap associated with the double-digit credit offtake. Fifth, banks have adequate cushion of SLR to meet any potential liquidity requirement. In fact, the outstanding absorption of liquidity under the standing deposit facility stood at 84,768 crores as on October 31st this year. That is 2 days ago. The Reserve Bank remains agile and watchful, continuously monitoring the liquidity situation, and is ready to undertake liquidity operations on either side so that overall liquidity remains adequate to meet the requirements of the productive sectors of the economy. Now, our markets department is constantly in touch with the banks, with the businesses, and I mentioned about so many measures. One thing which I would like to say is that our entire approach has been very consultative. Even in matters of liquidity also, we are constantly in dialogue with the banks, with the market participants, or during the times of COVID, we were having interaction with the market, with industry leaders, with industry associations like, and MSME and other associations, the Apex organizations. We are in touch with the market players, with the banks, and with the other financial sector participants. And as I mentioned, the RBI will take necessary steps as to ensure that there is adequate liquidity in the system to meet the needs of the economy. Now, let me now focus on exchange rate and Indian rupee. Exchange rate of the Indian rupee. And I would like to say as follows. In recent weeks and days, movements in the exchange rate of the rupee have been the subject of animated discussion in the media and in several other fora. Talk of unidirectional downward descent and the Reserve Bank's defense are dominating the narrative in the public space. It is therefore important to address the issue free of emotions and fully loaded with nothing but facts. On a financial year basis, that is from 1st April to October 31st, 2 days ago, the Indian rupee has depreciated by 8%. Over the same period, the US dollar has appreciated by 13%. This holds true even on a calendar year basis, that is from January 1st to October 31st. During this period, the Indian rupee has depreciated by 9.8%, whereas the US dollar has appreciated by 15.8%. On a financial year basis, almost all major currencies, barring a few, like, for example, the Swiss franc, the Singapore dollar, the Russian ruble, and the Indonesian rupiah, all other major currencies have depreciated against the US dollar by levels which are much more than the depreciation which we have seen with regard to the rupee. In fact, the Indian rupee appreciated against all other major currencies, barring, of course, these currencies which I mentioned, and of course the US dollar. And the size of the Indian rupee's appreciation was indeed the highest vis-a-vis the Japanese yen, by Japanese, when the INR's appreciation was highest vis-a-vis the Japanese yen, the Chinese yuan, the pound sterling, and even the euro. Cross-country comparisons of exchange rate movements are often made on an inflation-adjusted basis, or what is called in real effective terms. On a financial year basis, that is between March 2022 and September 2022, the Indian rupee has appreciated by 3.7% in real terms, even as the euro, the Japanese yen, and the pound sterling and the Chinese yuan have depreciated. Thus, even in real terms, the INR is the least misaligned in the face of tsunamis of global spillovers. The story of the currency movements following the war in Ukraine, the story of that is India's currency movements following the war in Ukraine, is more about India's resilience and stability in the face of unrelenting strengthening of the US dollar rather than a story of weakness. It is important to evaluate these currency movements against the backdrop of global and domestic macroeconomic and financial developments. Since March 2020, the world has been buffeted by extraordinary and repetitive shocks. I have spoken about the pandemic, the war as two black swan events. There is yet another shock, the globalized inflation. The most recent shock has been the aggressive and synchronous monetary policy tightening, leading to the kind of turmoil which we are seeing in the financial markets. The result has been tightening of external financial conditions, capital flight from emerging markets, sharp currency depreciations, and reserve losses. No country in the world is immune to this kind of turmoil, which has followed two previous episodes of global crisis. Yet, the strength of our macroeconomic fundamentals has stood out in comparison with peers, bearing testimony to the prudent macroeconomic policies and the resilience of the buffers which we have built up. An assessment of India's innate strengths can be gauged from comparison of the state of economy today after 3 years of multiple shocks with the situation during the taper tantrum of 2013. Now, I have got several data and statistics here, which in the interest of time, I'm not reading out. I have just given the data to show. Because, as I said, that let's not go by the headline that the currency is depreciating. We need to look at it contextually. We need to look at it in a granular manner. And I have given several data here. I don't want to sort of load all that on you. Those of you who are interested, you can have a look at it. Now, I have tried to also compare the present situation with what prevailed during the taper tantrum of 2013. Now, whether it is with regard to current account deficit or it is with regard to, the sustainability levels of our forex reserves, I have given several data and I'm not reading it out. Now, fundamental factors that drive exchange rate have moved distinctly in favor of India since 2013. In 2013, inflation in advanced economies was 1.4% as against 10.1% in India. The inflation differential of India vis-a-vis advanced economies is now negative, a rare development with several advanced economies experiencing double-digit inflation. India's growth differential with global economy has improved from 3% in 2013 to 3.8% in 2022. The corporate sector balance sheets are strong. The banking system is well capitalized. Credit growth is in double digits and growth momentum is steadily improving. The terminal interest rate that the US Fed is targeting is anybody's guess. But it cannot be a case that the US Fed will tighten monetary policy endlessly. When the tightening is over, the tide will surely turn. Capital flows to India will resume and external financing conditions will ease. In this complex world in which both push and pull factors are at play, the Indian rupee, which is market determined, should be allowed to find its level, and that is what we have been striving to ensure. As I have just explained, the Indian rupee has seen a very orderly movement since the onset of the current geopolitical crisis. We must deal with the global hurricane with confidence, and when I say we, I include everyone who is present here, all the businesses, all the all the stakeholders in our economy, the government and the Reserve Bank. We must deal with the global hurricane with confidence, endurance, and the courage of our conviction that we will weather this turmoil. Let me conclude by saying that the current global economy is sailing in extremely turbulent waters. Despite humongous challenges, the Indian economy has progressed relatively well. I would like to impress upon the banks and businesses to remain focused on reinforcing their resilience while continuing to grow and meet the market demand. They should continuously assess the risk buildup, if any, sharpen governance, and strive to maintain healthy levels of capital and other buffers. So far as the Reserve Bank is concerned, we remain committed to support and preserve macroeconomic and financial stability. Once again, it is a moment of whatever it takes. Thank you very much.
Thank you so much, sir. A very insightful address. Indeed, the message is very clear. So while keeping Arjuna's eye on the economy and local and global challenges, and you've been continuously, introducing several regulatory reforms and efficiency in supervision, and you're laying, you're actually endeavoring to lay down a foundation for a strong financial sector to ensure, the sustainable, strong, and inclusive growth of the economy. Thank you so much once again, indeed. Sir, would you have time for a few questions? There were a few requests out there, but so. No. So there are a few questions with us. I can just invite, may I invite Mr. Sanjeev Chadda from Bank of Baroda for his question, please.
Yeah. Thank you very much, Governor. My question is that there are a lot of consensus which were prevalent for a long time, which seem to be giving away. Among them is about the desirability of free global capital flows. Yeah. So among the consensus which are withered, one of them is the desirability of global capital flows. So in India, we seem to have had a golden mean in terms of having some controlled capital flows. But given challenges like FPI being impacted by Fed decisions, do you believe that this is the right time for us to look at what kind of capital flows are to be encouraged and what can result in some dislocation and also some vulnerability?
So would you like to take the questions together? So there are 5 actually. Okay. So may I request Mr. Shubhrakant Panda, the Senior Vice President, FICCI, for his question, please.
Honorable Governor, first of all, on behalf of FICCI, I'd also like to thank you for being present with us here today and delivering such a comprehensive address and agreeing to take a few questions, which I may say so is akin to dessert after a very satisfying meal. Earlier this year, RBI has permitted rupee settlement of external trade, and this has seen quite a bit of traction given the geopolitical developments. And while it is a good move in itself, is there also a thought process that in the long term, there is a need to develop local alternatives to global practices or global systems, much as being done with UPI? So I'd appreciate your thoughts on that. Thank you.
Amitabh.
Sir, thank you for taking the questions. Frankly, when you have proactively thought about what questions will be asked and answered them already, so I don't know what else to ask you, but Very quickly, two very quick questions. One is that you started your speech by saying that we are introducing the digital currency. We have started with the Kisan credit cards. You talked about SMEs. So with all these platforms being pushed for by the government and Reserve Bank of India, where do you see the traditional banking industry 5 years down the line when you're going to disintermediate almost everything that is happening out there? So we should start preparing for it. Second, you talked about the paper from RBI on climate and green financing. I mean, the Indian requirements are about $17 trillion if they have to meet the 2060 goals. Sir, at some stage, I know RBI needs to provide some kind of impetus and push. So as bankers, can we hope that it will become part of PSL one day and hopefully will help our cause a little bit? So just very two quick questions. Thank you.
Mr. Somani, the past president FICCI, and also the MD, the chairman of HSIL Limited.
Thank you for a very comprehensive address. Sir, if we have to transform our country into a developed nation like the Honorable Prime Minister's speech this year, we will continuously need to grow at 8% plus for the next many, many years. One of the sectors which creates a lot of employment and helps in the cause of the development of the country is the real estate and construction sector, sir. There, RBI has some guidelines in terms of priority lending, and for a urban purchase of a dwelling unit, the priority lending is 35 lakhs for a 45 lakh rupee purchase. And for non-metro purchase, it's 25 lakhs for a 30 lakh purchase. So now with high inflation globally and material costs going up, our request is, sir, that this figure should be looked upward in both cases, and maybe the RBI should link it to inflation index. So this need not be renegotiated or discussed on an ongoing basis. This helps the bankers and it helps consumers in terms of purchase of their valuable homes and dwelling units. Thank you, sir.
So there's one last question, Zareen.
So according to the recent BIS triennial central bank survey, INR is now the 15th most traded currency in the global market. So what do you think are the key actions and initiatives which could take India into the top 10 globally traded currencies?
Yes.
Thank you for the questions, and thank you very much once again for your very patient listening to my unintended, rather long speech. Now, talking about, I'll address this last question together because there was also, this on this rupee settlement and the rupee-based trading which you are mentioning. Now, we have introduced this rupee settlement, and as you have rightly pointed out, it is slowly gaining traction. Several banks from various countries, they are already in touch with us. Our banks from India are also in touch with us, with the Reserve Bank for opening the Vostro accounts. And I think there's a lot of interest among the importers and exporters also. So we announced this, I think, sometime in July. On July, I think July 6th or July 12th or so, we announced this. And it's just about, 4 months, 5 months. And I would expect the real transactions to pick up. And with regard to the share of the, the ranking of the rupee, I think it is linked to the size of, the growth of your economy. Once India becomes a larger economy, I think the volumes of trade and other things or the payments linked to the rupee. I don't know if I have understood your question rightly, but that will be linked more with the, the growth of the Indian economy. And we expect India, to become the, the sort of the fourth or the third largest economy. I'm not going into any year, but there are estimates for the same. But I think it will be more linked to that. But I see a lot of traction in going forward. And with the kind of disruption which, this entire, the war and the post-war, not post-war, but the kind of disruptions which have now being experienced all over, I think countries are looking at various other alternative modes of payment. And I think in this process, two things that will help India. One is our UPI going international. We have, linked up through UPI, the RuPay card and all. UPI is now going international in a very big way. I have mentioned about it in my address. And the other one is this launch of the CBDCs. Once the countries at the other end also launch their digital currencies, then I think, it will become kind of seamless and interoperable. And it will be, in that scenario, it will become very difficult to really categorize whether it's Indian CBDC or it's a foreign, other country CBDC. But I think that will also assist India, because we are one of the, we are among the few countries which has really, we are one of the pioneers in CBDC in that sense. And if everything goes all right, we will certainly be launching it, hopefully, sometime. And we are quite certain, we are quite optimistic about it. I am not at all having any reservations. So these are the things, this is what I would like to say. With regard to the, I know there was one point made about the construction sector and the priority sector lendings, and green finance as part of priority sector lending. Now, as you know, as I've mentioned, we follow a consultative process. After very wide-ranging consultation, we brought about several modifications in the PSL guidelines about 2 years ago. And we have just revised them, but we keep on getting suggestions, and we will it's a consultative process, and we will certainly give a look at all suggestions which come to us. We will give a look at it. Now, a question was asked about with all this digital and technology, where do we see traditional, bank functioning or traditional lending? Now, banks, I have said it again, and many of you are already doing it. I think banks also need to adopt technology, and you are doing it. So the character of, the way the banking system operates, that also will go a fundamental shift in in the days and years to come. All of us, the RBI and few of the banks now and going forward, all banks, we are working together to ensure this end-to-end digitized loans for certain segments, agriculture and the SME sector. So technology is going to play a big role, and in this scenario, what is important is that banks also must invest in technology upgradation. We just, the Honorable Prime Minister launched the DBUs, and I think almost every bank is participant in that initiative. The DBUs were launched on 16th of November. So together we are working, and it needs more dialogue between the regulator and the banks and the other players in the fintech space. We want to encourage innovation, but we also want to at the same time ensure that there is orderly development of the innovation, so that it does not lead to any kind of financial instability or disruption. But having said all this, having said that technology will be the future, having said that the banks must also, and this is very important, continue to invest in technology, I think the traditional bank branches will continue to be relevant. The way I see it, I don't see traditional bank branches to become completely irrelevant. They will be relevant, and I feel they have a major role to play. Given the nature of our country, the composition of our population, and the way our economy functions, I think traditional bank branches in the physical mode will continue to play, an important role. So that is the one. With regard to there's one more with regard to capital flows. You see, with regard to capital flows, let me mention that our market, India, is one of the most liquid financial markets. It's very liquid. In fact, we see, if we compare how liquid is Indian market, and if you compare it with several other countries or many other countries, I'm not talking about the advanced economies, even to some extent advanced economies. In our country, the entry and exit is very simple. All this talk of ease of doing business and all, it's okay. But a lot of work has been done to simplify the procedures, the processes, and other related aspects over the last few years. And our markets are very liquid. That is why you see, whenever there is an inflow and outflow, India gets affected. First, that is because our markets are very liquid. But the market should continue to be liquid, because We are not playing a T20 match or a one-day match. We are playing a perennial match. It's not even test cricket. It's much beyond that. So on a continuing basis, on an enduring basis, a healthy and robust financial market needs to be liquid and needs to have easy entry and exit norms. We are fully convertible in the current account. On capital account, as we have said time and again, we are moving towards that. But our capital account convertibility, so far as India and so far as RBI is concerned, is not an event. It's a process. And we are moving in that direction. We have undertaken so many changes about which I have mentioned in the speech, about this NDF trading. We have permitted the banks to do, NDF trading and so many other steps which we have taken. So I think, as a part of our financial market reforms, this seamless, easy entry and exit, liquidity, all these aspects are very important. Capital should flow into the country. Capital should move out. So far as India is concerned, I see very small amount of what may be called hot money. We don't see that kind of money which flows in and flows out. Even as I mentioned, last 5-6 months we witnessed certain outflows, but they have moderated. And people who pulled out their money, they pulled out because liquidity was becoming tight in those countries. But our interaction with all the players, with most of the players, shows that they continue to have confidence on the Indian markets and the return which Indian markets offer. So it's a question of time before they come back, and many of them are already coming back. Thank you.
Thank you once again, sir, for gracing the occasion and for your extremely insightful address and for also taking some of these questions. May I request Mr. Sunil Mehta, the Chief Executive IBA, for his concluding remarks, please.
We all have relished a very thought-provoking starter, a main course, followed by